All right, good afternoon, everybody. Event Trader here, just about to be joined by Brett Manning. Brett, you there with us?
Sure am. How you doing, Gav?
I'm doing okay, Brett. I'm doing okay. Obviously, keeping an eye on the markets here as we slip below that 50-day moving average in the S&P. I know you've been following the Dow a little bit closer here, Brett, or at least trading it anyway. A little bit closer. You got any levels that you're looking at right now, or are you just kind of watching things flow out here?
So this is a good example of something Jim and I talked about toward the end of last week, where you get uh, like a smack in the face range expansion. And my policy, as I expressed there, is to really make sure to not overtrade the initial range expansion and to try to make as few assumptions as possible until the dust settles a little bit and you get a kind of conversation going between market participants and reflecting on that move and now the expanded range that exists and the different character to the patterns, and then you start to look for new patterns to develop inside of that, which are going to give you more edge because you're going to have wider range. You're going to have the inside market a little looser, particularly in terms of some of the bots and algos. And you're going to be a little less crowded. You're going to get a little bit more follow through because people are a little bit more gun shy about protecting levels. So you get a lot of dynamics that start to generally improve the odds of profitability on any given trade. You can be a little higher conviction, and I tend to oftentimes even increase my size and definitely increase my frequency of trading in the aftermath of a day like this, but not on the day like this, because that's when you can get bit, because you're actually living in the world that is a patterned reality that's prior to this day and trying to fit this day into that reality. And, you're going to constantly be pushed toward some kind of reversion to the mean feeling and looking for certain levels to hold. But there's a new world now to some extent after seeing the data that we saw, and we're going to see what that new world looks like. But I try to be a little bit lighter now and try to make as few assumptions as I can and let it start to show me which levels are going to be important rather than try to guess at which levels are going to be important right now. So that's my mindset at this point.
Okay. So now when you're saying don't want to make assumptions, would like an example be, okay, we've broken the 50-day moving average in the S&P, that means we're going to go lower? Or when you're saying assumptions, what are you referring to in particular?
Either side of that one, for example, that the 50 days is even important right now. Who knows?
Fair
We'll kind of
enough.
see. Because if it is going to break, then it really doesn't mean anything. But maybe it's going to be defended vigorously, and I want to watch that process happen rather than try to guess at that process. And once I'll understand a little bit more about the type of context we're in, but we're still going to have things loosened up. So you can still be very opportunistic with, I would argue, somewhat easier setups, somewhat more promising and higher probability setups when you get into that reaction to the reaction or reaction to the reaction to the reaction kind of mode that takes shape after you get a day that has an outsized range, particularly one with such a clear and distinct and critical catalyst.
All right. So, and that catalyst obviously being the ISM. So I guess we could start with the sentiment data first here, Brett, and kind of take a look at the PMI numbers. One of the things that was sticking out to me, and we talked about it last week, the ISM, but also the PMI numbers, with in particular the PMI preliminary, and that was some cautious commentary around the around employment. Now, this morning with the ISM, we saw similar commentary. I had posted it earlier, where there's a lot of talk about a slowdown in hiring in some positions, some people being let go, and of course we have that jobs data coming out on Friday. Are you looking at any read-through on the ISM or PMI commentary on jobs in terms of that's probably going to lower your expectations for Friday, and therefore you're kind of looking at that as maybe a tradable event, or do you think that's kind of getting priced into the markets at this point and might be more of a buy-the-news event?
I think that it's possible. I mean, if I had to game that situation, I would probably game it thinking in terms of this ISM and the insight that we're getting from some of these leading indicators and surveys as something that maybe shows up more on the next jobs report. But because they're so close, these two data points, that it may have people positioning as if it's going to be clear in this data point. So I might think in terms of trying to perhaps, scalp short bond futures or something, but I really don't enjoy participating in that kind of trade where really I'm putting something on just ahead of a data point and trying to guess what the data point is. But like I said, the premise of this answer is if I was forced to, and that's probably, if I was forced to, that's probably what I would do. Maybe scalp longs in equity indices, scalp short in the euro, scalp short in the bond market, scalp short in gold, as just a set of positions that I think might be overly crowded with expectations that might actually be slightly ahead of schedule.
Okay, and the scalp short in gold, that's more of a positioning point than any reflection on what you would expect to see in terms of sentiment around gold and the data then, right?
Well, I mean, it would be similar to, scalp short bond futures. In other words, that there's loose, fast, weak-handed money that's going to be long gold into the jobs report, assuming that we're going to get a really bad number because of seeing this today. And I think maybe that number is going to be better than people fear now, even if the next jobs report might be worse. See what I'm saying?
Yeah,
the knee-jerk would be to sell gold, sell bonds, sell euros.
You think that it's typically what we've been seeing with the soft versus hard data?
Yeah, basically. Yeah, right. And
that's basically been over pessimistic, and you think that could play. Obviously, I'm not putting you on the spot with trying to throw out your own consensus estimate on this jobs number, but you think that there's a chance for that pattern to hold steady into this Friday jobs report?
Well, I mean, let's look at the data point that we just saw is a sentiment index of people who are being most directly impacted by the trade war, is how they feel. What decisions they're making, and maybe they're looking through particularly dark shaded glasses right now, and their assumptions about what's happening in the hiring markets may not be reflected in jobs data that looks back over the last several weeks or a month, but it may be something that plays out in the coming weeks and month.
Right. Okay. So with sentiment data, let's touch just upon the Citigroup Economic Surprise Index, because obviously that had been marching higher and was one of the things that we'd pointed out the last couple of weeks. I would assume that would come in, and one of the things that was interesting was I was taking a look against Bloomberg's leading indicator surprise index, and basically one of the things that I was seeing was that the Citigroup Economic Surprise Index generally lags the data from the Bloomberg Surprise Index, which includes more of the leading data, more of the soft data, I assume that means. Have you ever taken a look at the two corresponding against each other?
Which two? Sorry.
The Bloomberg Leading Indicator Surprise Index versus the Citigroup Economic Surprise Index.
No, I have not, but I assume that they're both different reflections of the same basic concept, and they should more or less confirm one story or the other, correct? And they did recently.
They should, but actually what caught me off guard was how much the Citigroup Economic Surprise Index had outpaced the Bloomberg Index, and the general thought is that Citigroup tends to be a little bit more of a laggard. And when these two diverge, it usually points to bearishness for stocks, is what I was looking at. So I was just curious if you'd ever done any comparisons between the two.
I have not.
Okay. I'll shoot it off to you offline. I don't want to ambush you with something that you hadn't had a chance to take a look at.
Yeah, no, please.
But I guess the main concept of it, though, and you could speak on this, would be that the general view is Bloomberg usually uses a little bit more of leading indicator numbers, probably more softer data looking forward. So, that would probably, again, fall in under that soft versus hard data that we've seen, probably why the Citigroup Economic Surprise Index is viewed a little bit more stronger as a good leading indicator. But, again, what would be your trading philosophy is the bottom line that I'm looking to get to in terms of if we start seeing this hard data outpacing some of the soft sentiment data. So,
So,
for instance, we got the
okay.
ISM this morning, PMI and everything, and they were all very negative, and the market reacted as it did. Construction spending, you could also argue, was a little bit lighter. But if we start seeing, for instance, tomorrow's ADP report coming better than expected, Thursday we got factory orders, Friday we of course have the jobs number and
Mhm.
stuff. If this data starts coming in, how do you view that as a reflection in terms of the type of answers that we're seeing in some of these surveys from people against what's actually going on in the economic world?
I mean, like we talked about and like we've seen, you can see that sort of dichotomy kind of resolve itself in one of two directions. Either people are being uh, uh, poorly timed in terms of or you got poor sentiment, you got people reacting to the feeling about the world and becoming more pessimistic than the economy really should be seen as, and you could definitely see that, and we've seen that at times, particularly during I would say this presidential administration and a lot of the media around it. There's a darker feel to things, even in seemingly periods when the economy is doing well. So you could see that people are unreasonably pessimistic, and that's coming through some of these numbers. But that really, at the end of the day, that there's an engine that's running, and it's running well, and so you're just going to continue to have demand pick up. People will need to hire people to fill that. People will need to order more inventory because stuff's getting sold off the shelves, et cetera, et cetera, et cetera. And I think as long as the credit cycle maintains itself, in this case, that would be particularly important. But you could also see, and this would be the worst case scenario, to see the sentiment data deteriorate, and then to start to see signs in a lagged fashion, just how it's supposed to work, that you start to see the hard data move into to kind of agree with the sentiment data that had been popping up, 2-3 months previously. So that's typically what would define the onset of a cycle downturn is that's why they're called leading indicators, right? I mean, that
Yeah.
you see the people that sentiment starting to sour. That actually leads to a different way of behaving. And this is all. I mean, if you remember the Turtle Beach metaphor, this is the turtles pull their legs in and the weather gets worse. And the weather being the hard data and the turtles' activity being the soft data in a way. So you can fuel the downside of the cycle just by people worried that other people are going to become more risk averse. I mean, ultimately the equation of counterparty risk, of lending behavior, of spending, of saving, of all of those things are really a calculation that has something to do with that kind of process. And I think that what we've seen typically is you can get false signals of sentiment data weakening and the hard data holding up well, or you can get the real signal where the sentiment data weakens and then in a lagged fashion the hard data weakens to follow.
I do think one of the things that was overlooked, and certainly this is, again, more of a forward-looking indicator, was the commentary around the inventories across the board, and most of the country PMIs that I was looking at was pretty positive. So not seeing a buildup of inventory that's going to have to get worked through. So I do think that
That's important for sure. I saw your
it's
point earlier too.
yeah, it's very important because it just suggests in 2 weeks' time, if we get a détente in the trade war, that you could see these orders pick up pretty quickly. So I guess that's the one thing that I would caution against people on getting overly pessimistic about these data points. But I do agree that it's obviously not a positive for the markets, and the selling today is very justified. But just keep in the back of your mind that for a cyclical downturn, while it's very much in play, it could be worked through pretty closely as long as these inventory levels are managed. So we'll continue to keep an eye out on that moving forward.
Let me just add to what you just said, if the credit
Certainly.
situation holds up. So you can get a series of shifts in exposure on the credit side that could
Sure.
exacerbate. I mean, we have a situation now where there's a lot of people, gleefully playing in the water with no bathing suits on. And if the tide goes out, you start to compound problems pretty quickly.
Very true, very true, and obviously we've seen a few of those with Argentina, of course, but I guess we could perpetually put them on the list. But when you see Ford and
Hmm.
Thomas Cook, which was
Hmm.
a British travel agency. Now, you could argue that the travel agency is perhaps a little bit dated in these times with Expedias and Pricelines and stuff, but
I'd call it quaint.
quaint. There you go.
Quaint.
That's a fair assessment. But it was a 150-year-old business. I mean, it's not like
Yeah.
they were new to the ball game. So, you start seeing some credit risk there. To a lesser extent, Forever 21. So you are starting to see some things, and I think that's kind of one of the big issues I'm running into with my Neo position here, where people just think that they're going out of business at this point. So you are starting to see the emperors that don't have the clothes really getting uncovered here, and that's going to be something we're going to continue to watch. Outside of that, Brett, I was taking a look through any of the sentiment numbers that we follow, and I had it pretty much mirroring last week in terms of overly pessimistic on the small trader put buying, the U.S. dollar strength, which we'll get into that in a second here because that's definitely one of the key stories going on. Hedge fund exposure and software is hard data, and then on the overly optimistic was the bear market probability, the NYSE high low. Um, and the mutual fund cash levels. So, you got anything to note on that particular set of sentiment data, or pretty much what we've been talking about the last few weeks?
Yeah, so I mean, the most important indicators have been more or less dead neutral for more or less the entire time that we've done this show. And like when I'm talking about, like, I mean, we had little flashes here and there with like the Robo or Lobo or the AAII stuff, or the stuff that I really look at to give me a sense of where you start to filter things into different time frame, different position size kind of participants, where there's a real important problem developing one way or the other in terms of an imbalance in how people are positioned. That stuff has just stayed neutral. We've had some really long-term stuff stay bearish, like mutual fund cash levels, stuff like that. And we've had the short-term stuff consistently gets very quickly pessimistic. So small trader put buying. A couple days ago or yesterday morning, I noted that we came into this week with inverse ETF volume, spiking up into serious territory. And people probably off of a lot of the impeachment headlines. There's a lot of real retail side pessimism or wanting to take advantage of the short side, which is why we went long the Dow yesterday and let it run overnight, and it turns out that was a pretty good place to take that off. I took it off right in front of the European Open in the middle of the night last night. Hopefully somebody caught that with me, but that was basically because we came into the week.
Was there any particular reason on that time and that you saw that led you? Were you just concerned about a rollover in Europe in general, or what?
No, it was a strict pattern. So there was a sloped line of resistance that we peeled off of toward the end of the day yesterday. That's why I reduced my size and widened my stop to make sure I stayed with it, because you'll often get that peel off at that sloped resistance line, but it will, given the base that we'd constructed and given where sentiment was, there was no way it wasn't going to at least seriously run up through that sloped line. And the target for that is going to be in the construction of that slope line, basically the previous high that was a part of that slope. So it turns into a flat line, right? And that was the highs from 926. So I wanted to run a little bit above that level. That's about 27040. It got right exactly to that and just put in a tail. And I know you've got the European Open coming up, so I just took it off there. I mean, that was within the target zone, above 27,000 I wanted. And it just took a little patience and a little late night, but that's a very, very typical process. And even if you get a breakdown, and I said this yesterday afternoon as we came into the close, even if you're going to get a breakdown out of this kind of, if you look at the daily chart for the S&P, NASDAQ, anything, you've got what looks like a pretty textbook kind of flag, like a bull flag pattern. They can fail or go up. Flag patterns are very unreliable. They can trapdoor out the bottom, or they can take off to the upside. And the swing point there is sentiment in a lot of ways. With neutral sentiment, tough to say, but what you usually don't get, if you get a little bit of a base at something important, you usually will get at least a move up through the sloped line to finding the highs as that thing is flagging down off of its little pivots. You want to get up there, and you want to get up to the previous top. And the breakdown you get is after you get that little fake up move, just like we got. I mean, the data obviously is the descriptive element involved today, but the pattern is still something that you might recognize looking at a lot of charts, where you get the flag, you get the pop through the slope line, up to the flat line, the prior peak, and then you roll over, and then you've got some more teeth to the rollover because you've sucked people in on the break of that slope line, and you've knocked shorts out who've been trying to bang it off those highs. The flag is like an arm wrestling match, and the bears are slamming that thing down, but when you form that little base, you're going to kick them out. You're going to at least kick some leverage out. You're going to suck in some weak hands on the long side, so you pivot off of that lateral resistance level and roll back over, and now you got repositioning on the next time through, so you get a little bit more gas to come down through, and you can break. I call it a failed flag pattern. Like, this can turn into very easily a failed flag pattern. It already looks like one on the Dow, but you'll always get that little slope line violation, and it was really just kind of about staying involved for that. I didn't know the data that we would have today. It just turned out to be kind of a lucky exit from that standpoint.
Yeah, definitely got up before it hit the fan, right?
Yes.
So good call, and then you made a little bit on the downside too, right? So
on the upside, on the downside. Yeah.
Well, the bounce on the downside.
Right.
So,
and that was the first reversion to the mean point where it hadn't become a necessarily different world in terms of ranges. So I want to point that out too. That was the point where you got an overshoot of that 2960 level, basically. And if you look at a 60-minute chart for the S&P, you'll see there is a kind of a series of lows before the pivot low that was on the 27th. So you'll see a series of them around, the 24th and the 25th. They kind of really solidified that area, and that actually was a bounce off of where we were maybe on the 10th or so of September. So you had a level there. Come back down, check it, overshoot, drag down through it. So I put that long on when we got down to, I guess, 29.59 or 29.57, somewhere in there. So we overshot that level a little bit, and then I just saw just a hint of traction come into the tape, and that's after those stops had been run. So I think that's a good point to look for a bounce, but it's before we really necessarily had a serious expanded range in the pattern. So fine to go reversion to the mean there, kept it small. Obviously, you saw how careful I was. Second we got in the money, stops to break even. I was quick and aggressive to take profits on it because it's a counter-trend trade. I thought that I might get a pop back up to, in the S&P terms, up into that 2970 area, but we didn't get that next leg. We just rolled back down. This is a hard trend. So, but I mean, that was something that didn't really violate my rule of not really trying to be too speculative in an expanding range bar. I think that after we broke that next low with follow-through, pretty much then I backed off, and I'm just kind of observing and trying to understand the shape of what we're dealing with now.
Okay. With that in mind, just as a heads up for the S&P, at least we're bouncing back and testing that 50-day moving average, which is now setting up as some resistance intraday here. So let's take a look, Brett, at some of the flows that we're seeing from the last week, and yet again another big inflow into bonds, about $9.2 billion, according to the Bank of America flow show survey there. $2.8 billion of that into gold, and we'll circle back around to that in a second, and $22 billion out of equities, which leaves our risk off year-to-date flows at $358 billion into bonds, and we'll talk a little bit more about the Bank of Japan moves in a second here. $15 billion into gold and $201 billion out of stocks. Any thoughts on those numbers? I mean, I know it's pretty much in line with everything we've been seeing and talking about really since we started this segment, I feel.
Yeah, no, right. It just continues to be, anytime you start to get a little bit of an attempt to move back towards some opportunistic bullish money flows based on some, we talked last week about you were talking earlier today about the Citigroup and Bloomberg Economic Surprise Indices. What they looked like a week ago was spectacular. That we were seeing this kind of real jump relative to estimates, and we'd seen recessionary forecasts dive, and we've seen, central bank Fed funds futures shift, and bond yields are moving higher, and money's flowing into the stock market and everything else. And then, the impeachment hits, and then now we've got the ISM, and who knows what we'll see on Friday, but there's just there's this process that every once in a while finds a way to start of flows trying to come into equities, and then something resets that extremely risk-averse, extremely pessimistic kind of mentality. And, big money, people who are in charge of large portfolios, remain extremely risk averse.
Right. One of the things we mentioned, that gold inflow, 2.8 billion. This was the second biggest gold inflow ever. I didn't get a chance to see the commitment of traders numbers, Brett, but you could fill us in on that. But in taking a quick look, I know you were looking for a flush on gold.
Yeah,
Probably in hindsight, you had your stop maybe a little too tight, but for good reason. There's so much headline risk out there,
sure.
and you actually ended up getting some headline risk. I think you still probably would have been able to stick around in the trade. So it's a good call. Just real tricky with the headline minefields out there for playing it. When you see something like this with the gold inflows, second biggest ever,
Hmm.
do you just view this move in gold as kind of a lead blanket offering at this point? And therefore, no matter how much inflows we have in there, you're going to be seeing some profit taking going on? Or do you see this perhaps being also in part because of that strong dollar, which will expand a little bit on the strong dollar and some of the knock-on effects there? How are you viewing this data that we're seeing in gold in terms of the inflow, and obviously a lot of headline risk, and we still kind of see gold selling off?
Well, okay, so a couple of things to contextualize that. So based on the CFTC data that hit on Friday, and I'd already followed this up earlier, based on that, this is right now the all-time heaviest speculative long position in gold futures. This is the most crowded in terms of its futures disposition. This is the most crowded long gold has ever been, including when it was up testing 2000. So, and you also see then the inflows in Bank of America, its second biggest 1 week change. You're seeing some of that in futures. You're probably also seeing it in a variety of different places, including GLD and all sorts of stuff. So there is a raging speculative bull crowd position thing happening in gold right now.
And plenty
Now,
of headlines to support that push in.
oh yeah, right. But so that what that does is that puts me in a place where, just based on the systematic way that I approach things, and I'm not saying gold has to go down. I'm just saying I'm not a buyer of gold under those conditions. And that doesn't even mean, I think there's a decent chance it could move to new highs off of this. I'm not going to be a part of that, and that's fine with me. It doesn't fit the criteria that I consider to be an opportunity in markets. I look for there to be a disparity between those concepts, that I see a directional implications that go against where the exposure profile is leaning. Generally speaking, it's not necessarily hard contrarianism. It can be in the mode of a trend. It can be on a relative basis. We can see a trend up that has, a too crowded of a position. It pulls back just a little bit, and there's an outsized exodus from that market, and it suggests in the context of that trend that it's an opportunity. The trend has a momentum of its own. People got outside of where they've typically been exposed relative to that trend, and now it's going to snap back into what's been normal in the context of that trend. There's a lot of different ways to construct that type of process that I go through to look for these sorts of opportunities. But one thing is real certain. If I see something that's at all-time high speculative crowded position, something like the gold market where I've had such a large amount of experience with it, I just feel like the probabilities aren't well set. I'd be really betting on headline flow to help me out at that point. Now, of course, today is a perfect example of headline flow really helping those folks out. But it is going to be a little bit waterlogged on some of these moves. It's going to be tougher for it to really just take off. It could churn its way higher and eventually break out and get to, by far and away, redefine our concept of what all-time high speculative interest is. It could get to 500,000 contracts long. It's never been above 336. It could get to 500,000, 600,000. Who knows? But it's also a situation where if that script stops reading right in terms of these catalysts, then it's going to flush out again, and probably violently. So, if you see a great jobs report on Friday, perfect example. If we see a great jobs report on Friday, this could be at 1,400. There's too many people making that bet right now all together in a crowd. And when that sort of situation starts to empty out, when people get into a situation where they're competing with one another to get a better sale price and they're all trying to get out the exit at the same time, the bid's going to back off, and that's when you get those air pockets and what I call the puke. So we didn't really see that much of a puke on this decline. It could happen still if we get the right type of data. But at the same time, this is a really bad ISM number. We've got a lot of turmoil in all sorts of, different aspects of the macro situation right now, and that could just intensify.
Yeah, and again, like you said, ISM, I don't know if you had a chance to look at the World Trade Organization, their latest outlook. They cut pretty drastically to their numbers, so plenty of headline risk. We got the World Economic Forum, their economic outlook from the IMF is going to be coming out soon, so going to be curious to see how this all plays out. And one of the things that we're seeing at the heart of all this, Brett, is a strong dollar. Now, again, you're talking about
today notwithstanding, but yes,
today notwithstanding, exactly. So, but I mean, we did have a pop in to multi-week highs early, right, in response to the Japan news. So a little bit of a rollover here. Probably the idea, obviously, of recessions picking up here, and how that might impact the Fed. But it still looks like most of the flow that we've been seeing is going into the dollar. And I guess I want to ask you on how you look at that for, number one, your euro short, number two, multinational corps and the IWM, and number three, gold. So what are you looking at in terms of dollar? Do you think the dollar is maybe overstretched and perhaps we start seeing some weaker data that maybe suggests that the divergence in monetary policy isn't as far away? And again, we're going to have to get into that Bank of the Japan bond auction to discuss that a little bit more too. Obviously, we've certainly seen plenty of dovish commentary from Draghi, who's coming up to his last meeting here in a couple of weeks. But what are you looking at in the dollar, and how do you see that as a knock-on effect for the rest of the markets?
Okay, so I'm in no rush to cover the euro short, first of all. I believe the situation is one where if it's getting worse for the United States, it will be even getting worse for Europe. I think that if the feed-through of the idea that you've got probably dollar liquidity issues at that point, certainly, and that you're going to see decreasing demand from the world's, let's just say in the world where this ISM data point is a meaningful indication of deteriorating macro data out of the United States, I think that would actually
with one thing too, Brett, exports were 41 in that data point too, so obviously a pretty big drag there on all these issues.
Yeah, and if you think of a cycle rollover situation, I think that the dollar will actually strengthen under these conditions, and particularly because, as we've discussed, the one major economy in the world that's going to be incapable of essentially inflating its economy through a fiscal channel, at this point it would appear anyways, is Europe. So they become the drag, and I think that that puts even more pressure, upside pressure on the dollar, even as the data is worsening. I don't think that there's anything the Fed could come out and announce that would do what Donald Trump wants it to do. So I think that that situation could intensify despite the knee-jerk reaction that we're seeing today. I could be wrong, and if I was wrong, it would have something to do with Europe being ahead of us in the cyclical phase, that this is a very shallow correction in the cycle, that they're going to come out of it while we go into it, and also that the euro is being used as funding currency, which means that as risk aversion builds from the United States downturn, you'll see a lot of covering of that exposure so that people will be closing out speculative positions and refunding it back into the euro because they borrowed euros at negative rates to fund speculative positions. So you see the funding currency positions close at the same time that you see European data mysteriously improve while the U.S. is rolling over, and it's sort of like we're moving in sequence with each other. That would be the type of scenario that would mean that I'm badly wrong on this trade, and that's fine. I've got my stops basically to a synthetic break even, and we're way in the money, and I've got lots of room to let this play out. My theory is that We haven't seen the worst of things in Europe, particularly if we have the United States starting to deteriorate in step. It was originally put on as a position that was based on the idea that we might see a globally synchronized kind of contraction situation start to develop somewhere over this 12 to 18 month time horizon, something like what the yield curve would be trying to signal. And we're going to find
And
out.
another thing to keep in mind too is we know that the Trump administration definitely likes to put max pressure on a country and a region when they're in a little bit of trouble with the idea that they could get some concessions. So that's another thing to keep in mind there too, right?
Yeah, absolutely. Right. You've got a zero sum world now, even though you don't really. You've got people who think that it's a zero sum world now, which is likely to exacerbate downside.
Right. Okay, so we talked a little bit about the dollar in that aspect. Let's talk about this Bank of Japan news, or well, the Japan bond auction and how the Bank of Japan was involved in that, because I think this really talks to the heart of the matter that it's really been a key center point of what we've been talking about in the last couple of weeks in this flow show. First, the Reserve Bank of Australia cut 25 basis points this late last night. That marked the 44th global rate cut in 2019 and the 752nd rate cut since the Lehman blow up. Now I think central banks have a total of 14.9 trillion of negative yielding bonds on their books. And then we get news last night about a Japanese 10-year bond auction. It's kind of why I always follow these bond auctions, just because you never know when something is going to be of interest here. And we certainly got plenty last night, where it was the weakest bond auction in about 3 years for Japan. This set off bond futures tumbling by the most in the same 3 years. And when you think about it, there's basically margin calls for investors that this would set off, and that's one of the things you always look for in a debt auction. And there was a few things of interest here that caused this auction to be so weak. Basically, the Japanese government has been so heavily involved in some of their other from their post office to their government pension investment fund, have all been involved in heavily monetizing the JGB, the Japanese government bonds here. So the Bank of Japan basically stepped aside, and what they're trying to do is steepen the yield curve. But we've talked a lot about this, and what that means is they're simply not looking to buy as many of the long end of the Treasury curves. The idea being that the lack of demand drives up the yield prices in order to entice people to come in. We talk a lot about the search for yield, and this is basically a perfect example of how that's done. So what we have is the Bank of Japan stepping back from its bond purchases. There's another set of bonds to be auctioned off on Friday that's going to have a lot of attention ahead of the jobs data. And on top of the Bank of Japan from stepping back from some of these bond purchases, which also highlights their concerns that these negative yields and the lack of term premium is having on the Japanese financials and the banks, we also get news that the government pension investment fund is pivoting towards buying more foreign debt, which takes away yet another big buyer from these Japanese government bonds. Now, that's leading to a lot of questions on the overall monetary policies from some of these central banks, as really just the idea of continuing to buy bonds and driving these yields down lower hasn't stoked inflation, certainly hasn't caused any sort of recovery and driven investment the way people thought. What were some of your early takes when you started hearing this news crossing the wires?
So, all right. So my belief is that if you read through all of the double talk and excessively complicated central banking language around this, the reality of the situation is they have a lot of they have a very aging population in Japan, and there's a lot of people who are their consumer behavior is governed by savings, and they can't earn any return on their savings. And so it's actually, you keep pressing down interest rates, and all you're doing is causing a higher savings rate. And at the same time, you're making the entire banking system unprofitable because they don't have any kind of net interest margin. So they've been worried about this for a while. Doing this, I personally doubt that this is going to be very productive. I believe that, and I said this morning, I think that this could actually, end up kind of backfiring on them to some extent.
You think it sparks a panic, perhaps, in JGBs with just mass selling of them, or?
Well, I mean, if you
I mean, the government owns most of them, right? So it's going to be tough for them to sell it.
It's just there's going to be, I think there's going to be more private sector demand to buy them. So I think that money is going to flow in and lower their long-term interest rates against their will. Even the central bank's not doing it anymore. I understand there was a knee-jerk reaction against that, but if you get souring sentiment and risk assets at the same time, then you're going to have a snapback where people end up, just like we look at the U.S. bond futures today. You can see what they did overnight in reaction to this, and then look what happens off of this bad data point. If you get any kind of cyclical weakness, the central bank may not be buying the bonds, but a bunch of other people will, and they're going to be doing it because they can sell them back more. They can sell them back later for more. You actually turn the Japanese bond market into, you increase the availability of an asset that can be a speculative winner in an economic downturn. And you maybe increase the likelihood of that economic downturn by the central bank stepping back. So my belief is that it will backfire on them, but I don't know. I do think that it's certainly.
Do you think a lot of the money ends up here buying U.S. Treasuries? Because I mean, one would think that would be a pretty enticing place to go if you're looking for yield. And they're talking about the pension funds considering currency hedged overseas bond holdings as similar domestic debt investments.
Go ahead.
They're therefore driving them into really adding to their treasury holdings right now.
So I think that there's three main reasons if you want to get into the intentions of the buyers, and it's a little bit inside baseball for people who don't really follow currency markets and bond markets a lot, and that's probably most of our subscribers. But basically, you can profit from buying a negative yielding bond in a couple of different ways. One, if it just appreciates in value. The bond market is the opposite of the yield, and when you see a falling yield, you see a rising price of a bond. So it's a trending market, and you can buy it and sell it back for more later. You can also buy it and use it as the basis to sell forward swaps for people who want to hedge, so that other people in Japan want to buy U.S. Treasuries, but they want to hedge away the currency risk, and they have to buy currency hedging, which is a forward rate swap, and you can only provide that for somebody if you own the bond underlying it. So you can actually earn by providing the mechanism that allows them to hedge their currency. They end up paying you like 1.5%. So you can buy a lot of Japanese government bonds and turn them into a facility for hedging. Something like if you buy a stock that everybody wants to short, you can lend out the shares and make a profit from it. Think about that. So you can do that with Japanese government bonds as well. So you can actually create a market for people who are looking to currency hedge. And as currency market volatility picks up, you can make 1.5% to 2% on these bonds that look like they're negative yielding. So there's that mechanism. And then, of course, just as you said, that money could end up in an arbitrage relationship with simply a higher yielding market like in the United States. But I think either way, there are market forces. The bet that they're making would be for, I think, not really to assist the economy, but they're almost cornered into it, and they really need to put themselves in a position where, or the world needs to put them in a position where they're in an improving environment while they try to steepen their yield curve. Because if they're in a deteriorating environment, then something like this isn't going to work at all, and it's just put people wrong-footed. Like today, by having the ISM number come after that, and I posted this earlier, that actually exacerbated, I think, the reaction to this ISM data point. Because
I'd agree with that.
Because short the bond market.
Yeah, I'd agree with that because I know when I was reading this, I was looking at because we talked about that flow data and seeing money flowing out of bonds into equities, which had me a little bit more upbeat, and I just completely lost track of the fact that the ISM was coming out. I talked about it, but like I just didn't think we'd see such a negative reaction to it.
Hmm. Yeah,
So
right. I mean, I think part of it is that everybody came into the day short the bond market because of what happened in
yeah,
Japan last night.
yeah.
Yeah.
So all right. Well, I'll tell you what, Brett. We're going on about 45 minutes here. Is there any ideas that we haven't touched upon that you were looking to chat about?
I think that we've covered a lot of different things. I think that we can circle back around and maybe talk later in the week. I think this is going to be an interesting period, and we want to see how the dust settles on this because we came into today with a lot of people, a lot of retail money really hedged and on the sidelines, and a lot of larger money really hedged and on the sidelines. So the
And
fact that we're
first
seeing
of the month or first of the quarter too, first of the
first of the
month as
quarter,
well. So you would
yeah.
think that a lot of 401k money would have been put to work today and stuff.
Right, so that's probably just wait and see mode now. But I think that I mean if we get a much better than expected jobs report on Friday, and now obviously the whispers will be for something darker. And people are wrong-footed into that, and we get this sense that we've got this continuing divergence between the sentiment side of the economic data and the hard data. The hard data continues to hold up. People could be really wrong-footed the other way again, and we get a raging rally back up. So it'll be interesting to see how all of that plays out. But I like to say this often when we get a sentiment imbalance like we have now, that can work great as a positioning instrument to understand where people are leaning. But if you start to get a serious deterioration in economic data that kind of goes above and beyond anything we've seen in the cycle, and you start to look at that process of the tide going out, and you start to get the possibility of credit spreads blowing out wide, and all of that's going to supersede, inverse ETF volume. Like that, that's not going to matter. The market's going to tank. And the people are trying to get out in front of that. People are speculating that may be what's happening here. And we'll have to see. There's that bet that's coming in, and there's those hedges that are in there. But if it turns out to be right, there's going to be a lot more downside. So we just want to kind of allow the process to really kind of move. And I would also take a look at the transportation index today, just as another kind of a sign. I mean, that's a massive down bar that's way down through the 200-day. In a situation where we already had that that age-old idea of the Dow theory market cycle top, where we did not make a new high in the transports when we did make it in the Dow, and now you're seeing aggressive downside there, which would be another old school kind of way of looking at the action today in response to that ISM data as being powerfully cyclical in terms of positioning. So that's what people are thinking, is that this is indicating a more a turn in the nature of the type of economic downside that we've seen, that this is a turning point toward something that's going to become something that has the chance to feed on itself, and we'll just have to see.
Yeah, it's gonna make for a couple interesting sessions coming up, and to factor in on top of that too, Brett. Of course, a lot of Fed speak going on. I mean, just looking at tomorrow, we got Williams. Thursday, not as busy on Thursday, but Friday, following the jobs number, we got Powell, Brainerd, George, Quarles. Obviously, Powell's going to be the big one there. And just right at the same time, those job headlines are hitting Rosengren. So overall, should be an interesting couple of sessions to kick off Q4, and of course you'll get a lot of people talking about the last time we kicked off October, right? Which saw some pretty aggressive buying that set up a pretty difficult Q4 that culminated in that Christmas Eve massacre. So gonna have a lot of people on their toes for sure.
Yeah, as painful as that was for long-term portfolios, but that was some fun trading.
Well, let's hope we can make it fun again with some more good calls by you there. So,
all right.
All right. Well, Brett, as per always, thanks for joining us. And if anybody's got any questions on anything that we discussed or wants any follow-up, feel free to write in. We'll be happy to take a look at it. And we will be posting this for anybody that might have missed the beginning to the site here in a little bit.
Thanks a lot, guys.
All right, Brett. I'll talk to you soon.